This is probably one of the most depressing videos you will ever watch on investing. We're going to zoom out here. We're going to look at what is happening with stocks, what is happening with bonds, what is happening with the US money supply. How is this all relatively related to one another? Because then we can find out how much really can we get ahead by saving and investing. And to start this all off, let's have a look at gold. What we've got over here is the long-term gold price chart. And this looks quite okay. We are at an all-time high. And so yes, gold could be considered a long-term inflation hedge. But we always have to ask ourselves, what's the opportunity cost? Should we put some money in gold? How much should we put in gold? How much are we potentially losing by investing in gold instead of, say, the S&P 500? And so the US dollar valuation of gold isn't actually that important. What matters much more is the relative performance. And what we've got over here is gold divided by the S&P 500. The vertical line here is Bretton Woods. That's when the backing of the US dollar with physical gold stopped. That's when people rushed into gold. And then in the 1980s and 1990s, gold underperformed stocks massively because technology did really take off. Those are by no means small fluctuations. This is a minus 97% move. So had you decided at the beginning of the 1970s to get into gold instead of stocks because gold was performing relatively well and you held for 10 years, then you would have had only 1/30th of the purchasing power compared to the person that bought the stocks low. So those are massive, massive waves. And one might consider timing those waves. What we've got over here is a 100-month moving average. So you would go mainly into stocks when the momentum for gold is negative, and then you turn around, get more into gold once the gold price picks up again. Currently, we are very, very close to that moving average again. Yes, gold is at all-time highs, but it hasn't yet broken the long-term negative momentum versus the S&P 500. Now here's the deceptive part about all of those charts. The issue is that there's more and more US dollars floating around over time, right? The US money supply is expanding, US M2 is growing over time. Thus, we can't really value things in US dollars, or if we do, then we always see rising charts for everything, for gold, for houses, for stocks. So it's not really that useful to look at US dollar prices for the long-term charts, because this is how the monetary base expands over time. This is a linear scale. On a logarithmic scale, that's pretty much a straight line. Sometimes it goes up a bit faster because of COVID, then it goes up a bit slower because of rising interest rates. But overall, the long-term trend is pretty clear. This goes up by roughly 6.5% per annum. So the official inflation rates, they just look at how much are consumer goods getting more expensive over time. But the issue is that those consumer goods get easier and easier to produce over time because of technological progress. In other words, what has been stated by the inflation rates is not the real purchasing power loss over time. That's actually much larger because a lot of money then goes, for example, in houses or in education or in medical care, etc. So if you don't want to fall behind long term, you have to make sure that you increase your income by at least 6.5% per year. Same, of course, with your wealth as well. And so this is the gold price divided by M2. Also with massive fluctuations, this is a drop of 90% roughly. The price of gold does somewhat follow the monetary expansion, but still, how good of an hedge is this really? When you might need 10, 20 years to get back to a somewhat fair equilibrium level? It depends if you want to protect your purchasing power for the retirement in 30, 40 years, or if you're actually somewhat dependent on that money a bit earlier. You have to wait potentially for a very long time. And so this is what we see. The US dollar valuation of gold is going up. The US dollar valuation of the S&P 500 is going up. The US GDP is going up. But it's all going up because there's simply more US dollars floating. This is the S&P 500 divided by the money supply. There is no real outperformance here whatsoever. Yes, the S&P 500 is a price index, not a performance index. So on top of what you see here, you also get dividends. But that being said, there's also taxes, there's also fees, etc. So maybe one can even forget about the dividends. And this is how much you're getting ahead by buying the S&P 500 versus spending your money today. You make a gain of 23% over the course of more than 60 years. Congratulations, you're saving for decades and decades, and in the end you have a higher US dollar amount, but you can't really buy much more with it, at least if you're not just buying consumer goods like the TV that gets cheaply produced in China. So really, by saving and investing the traditional route, you're not really getting ahead. You're simply just putting money aside for the future, but you're not really getting richer than others. If you're only saving and investing in the S&P 500 in order to be super wealthy in the future, that's, I believe, the wrong approach. It still makes sense to save for that emergency fund. It still makes sense to save to have some money for retirement, but it doesn't make sense to save and just randomly invest in an S&P 500 ETF if you want to get really ahead. You're not going to get ahead because pretty much all of the returns that you get with stocks long term are just monetary expansion of USM2. And here comes the dark side with all of this. It appears that the US economy is growing all the time, right? The GDP is going up pretty much most of the years. But again, the GDP is measured in US dollars that inflate over time. There's more and more US dollars floating around. What about looking at the US GDP divided by the US money supply? Here's the GDP divided by USM2. There was no real growth for a long time. The 1990s were pretty good, but after 1997, the US GDP divided by USM2 fell by 42%. This is why it's not good enough anymore to just be average, to just get a job at a corporate company, to then feed your whole family. The entire economy is doing much worse, even though it doesn't look like it. In real terms, in real purchasing power, looking at those 6.5% monetary expansion, the US GDP went down by more than 40% in the last 27 years roughly. And on top of that, we've also got that more and more of the GDP, of course, goes to the top earners, right? There is still the divide between rich and poor. So the middle class gets really shredded here. You have to be among the top 10-20% of earners not to fall behind. This is unfortunately the sad truth that we are in. And the big question is, how much further will this go? Because if we just continue to decline and decline and decline, then at some point this might also impact societal stability. As in, there will be more crimes, there will be less families, there will be all kinds of negative side effects that we're already observing in the last decades. So this video is simply showing the reality of the world we're living in, right? Unfortunately, we can't afford to be average. We have to be way better than average just to be able to survive. The system is not set up to favor the masses. The system is set up to favor a few winners. And so I hope this video is simply a wake-up call, right? You can't just follow the traditional path. You have to do something that most people aren't doing. You could be somewhat entrepreneurial. You could be trying to beat a market by learning a lot about that market. This doesn't have to be crypto or stocks. This could be something completely different. You have to be able to differentiate yourself because in the system, unfortunately, if you do what most other people are doing, then you will simply just go down with everyone else. Your living standard is going to decline, and you will see how some people will own everything and most people will have pretty much nothing. I hope you'll take this as a call to urgency. I hope you will take this as an inspiration to do something that makes you stand out. Don't believe that just having a job, just saving some of that money in the S&P 500 will be enough. It's not enough. You have to go way beyond that. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. This channel also has a Telegram. Feel free to join us. Link is down below.